Okay, hello everybody. My name is Brian Murphy. I'm one of the advisors here at EH Financial. What we're going to do today is we're going to do a video extension of our newsletter, Money at Work. And I'm sitting here with Jason, and we're going to discuss the awesome topic of interest rates.
I'm Jason Campbell. I've got to meet many of you. I'm also an advisor here. And yes, on deck for us is a Money at Work that's going to focus on interest rates and what that might mean for the rate environment and your portfolios in particular.
So the Federal Reserve caused a little bit of turmoil the last few weeks by, per some experts, not cutting rates in the last meeting. We saw a lot of volatility in the stock market last week, especially even a little bit the week before that. The market consensus now is that they expect the next rate meeting, which is mid-September, that they expect to see either a 1/4% or 1/2% cut in the federal overnight lending rate. Now that overnight lending rate doesn't necessarily affect most people, but you will see some effects on if you have a home equity line of credit that's tied to prime. Some people will see some of the rates will drop kind of down the line, whether you're looking to get a mortgage rate that's a little more palatable or something we've seen over the last few years. So we anticipate some downward pressure on real estate, in particular on the short end of the real estate curve, let's say the 0 to 2 year, and then you should see some effects in, let's say, the 5 and the 10 year. What do you think, Jason?
Well, I think that sounds right, and that's what we're given to expect. But at the same time, we have to be relatively adaptive to whatever the Fed does. There have been rumblings about this interest rate cut for quite a while now. We don't want to be so reactive as to assume necessarily what's going to happen, because the Fed has had some rumblings about rate cuts earlier this year even, and did not come through. But what we ultimately have to do is we have to be prepared. Prepared for as much as a 1/2 point cut coming up in September, and potentially another 1/4 point to 1/2 a cut before the end of the year. Whether it materializes or not is one factor, but ultimately we just want to make sure that we've got a game plan here for the clients regardless of how it shakes out.
So what we've done to date is we've positioned a lot of accounts with some short-term treasuries. We've taken advantage of the really, really nice yields.
Right.
I think those are coming to an end. So over time, I think that trade that we've gotten that's been very lucrative for us and our clients year to date and over the past year and a half, we'll slowly start to transition out of that. So expect us to reach out to you as we have those short-term bonds maturing, because we may offer a different alternative, because I think that the renewal rates are going to be much lower than the actual current rate. So if you're used to getting 5% on your short-term treasury, I think our future is going to be closer to 3 than it will be to 5.
Yes.
So we may look to transition out of that into something that will not have as much interest rate exposure. The beauty of utilizing those rates is, as rates went up, down, and sideways over the past 2 years, we and our clients were immune. It didn't matter to us. So those rates were pretty much set in, they accrete, and then they just mature at full value, and then we do it again. So it's been an awesome transaction for us, but again, nothing good lasts forever, so we're probably gonna have to transition that. But again, it has been a very exciting time. I do think it will be coming to an end. Probably Q4 of this year is when I think it would happen. We already see downward pressure on rates on the 1, 2, 4, 6, and 1 year bond. Our 10-year treasuries come way, way down as well. So at one point in time earlier this year it was at 5%, now it's at the low 4s. And so that'll give you an opportunity too. If you need to refinance your mortgage or you're looking to purchase a house, you're gonna see rates for mortgages not in the 7s, maybe in the high 5s, low 6s. Which again sounds high, but historically is actually very, very low.
Yeah, historic lows, absolutely. And one of the things that we've been happy to do is, as most of you know that have been participating in some of this rate environment via treasuries or via government treasury money market funds, is we have been looking at those particular holdings as a way to maybe provide the ballast or the buoy in your portfolio that bonds typically have. But unfortunately, as many of you know, especially after 2021, bonds have been less than reliable, if not just paltry across the board. And with that in mind, that's where we're looking to see if this rate environment does make it more attractive to increase that bond section of your portfolio. That's one of the things we could potentially look at. But ultimately, we just cannot count anymore on this 5.5% essentially free lunch from the Fed.
It's been nice.
It has been nice.
It's been very nice.
It has.
Expect to hear from us in the next 1 to 4 months, especially during our portfolio reviews. because we are going to be discussing what we want to do with those short-term bonds and the short-term interest rate exposure, and really truthfully all interest rate exposure in your account, because I think times are a-changing, in the words of Bob Dylan, and so we're going to see a lot of things kind of moving around. Again, I think the environment that we have now is not going to be the environment we're going to have tomorrow, so we're probably going to need to be a little more proactive than we have been in the past, especially with those short-term treasuries, in response to what we anticipate the Fed will do over the next 3 to 5 months.
Yeah, it's a conversation we've had with a lot of you already in our portfolio reviews, and we do look forward to having some more of those after we see what the Fed decides to do.